As a beginner who's thinking about investing in dividends, can you take $100 bill and turn it into many more? Yes, you can. But dividend investing is not a get rich quick scheme. It does take time. But the beauty about dividend investing is that from the start, you have a passive income source that also builds you wealth. That's why today I want to talk about some of the topics when it comes to dividend investing. If you are a beginner, such as how I pick my stocks, how I pick my dividend paying stocks, the specific metrics that I look at, and also my dividend strategy and my dividend portfolio. So let's just jump right in. If you look at the list of Bloomberg's billionaires, you'll see a lot of billionaires on that list that own stocks or own companies that pay a dividend. For example, Bill Gates, Warren Buffett, Amancio Ortega. Everybody knows Bill Gates from Microsoft. He used to be the CEO of Microsoft. But what a lot of people don't know is that Bill Gates owns a holding company called Cascade Investments. That holding company owns stock in companies such as Republic Services and even Microsoft. Both pay a dividend. And Cascade Investments has produced over $50 billion in a combination of stocks and dividends for Bill Gates. Amancio Ortega. He owns a large percentage in the company called Inditex, which is the largest clothing retailer. When it comes to dividends, he has received over $10 billion in dividends from his company. And then Warren Buffett, who owns Berkshire Hathaway. In Berkshire Hathaway, he owns stocks in companies such as Coca-Cola, Procter & Gamble, Johnson & Johnson, Costco, all these companies that also pay a healthy dividend. Now, everyday investors like you and myself, we don't have millions or even billions to invest in the stock market. But dividend-paying stocks do open up the doors for us to build our wealth. Let's start with the basics. Let's look at what a dividend actually is. A dividend is nothing more than cold hard cash that hits your brokerage account as a shareholder from a company that you invested in. Now, not all companies pay a dividend, but for the companies that do pay a dividend, and especially the companies in the US that do pay a dividend, they usually pay a dividend on a quarterly basis. One thing that I always pay attention to when I'm looking at dividend paying stocks is that these particular stocks that I want to buy need to be able to grow their dividend faster than inflation. Inflation, of course, is the rise in prices for goods or services over time. So for example, let's say you go to your local grocery store and you want to buy a bag of potato chips. It might be $2.50 today. Come back a year later and it's selling for $2.75. Or let's say you want to buy a Coke and it's selling for $2. Come back 6 months from now and it's going to be $2.10. So inflation causes your money to be worth less over time. Your money actually loses value. Inflation on average is 3 to 4% each year. So let's say you had $50,000 saved back in 1999. 20 years later, your buying power went from $50,000 to $32,000 because of inflation. That's why when I look at investing in dividend paying companies, they need to be able to keep up and grow their dividends faster than inflation or just keep up with inflation. If they can keep up with inflation, so a minimum of 4%, the money that I invested is able to retain its buying power. But of course, if it can increase the dividend faster than inflation, faster than 4%, to me that's even better. So when investing in these dividend paying companies, I'm looking for consistency and stability. Consistency in the sense that I look at the last 10 years or more and I want to see that this company has been able to consistently increase their dividend per share. And of course, stability. In times of economic turmoil, when the stock market might crash, these dividend paying companies that I invest in continue to pay a increasing dividend even during a stock market crash. So how does this whole thing work? How can I buy these dividend paying securities and where can I see my dividend? In order to get a dividend, you need to buy securities that pay a dividend. Securities being a stock, a mutual fund, an index fund, or an ETF. Now, in order to buy these, you might have a brokerage account open or you can use your 401k, your Roth IRA, your IRA, or even a 403b or another investment account that you might have opened. One company that pays a consistent dividend is the Coca-Cola company. Another company that pays a dividend is the Nike Corporation. An index fund or an ETF that pays a dividend is the S&P 500 from Vanguard, index fund and ETF. Now, with an index fund such as the Vanguard S&P 500, you're going to get a quarterly dividend from the underlying companies that this index fund is invested in. This quarterly dividend gets automatically reinvested into buying more shares or even fractional shares in that S&P 500 Vanguard index fund. But if you own individual stocks, for example, the Coke stock and the Nike stock, you have the option of either reinvesting those dividends or having that dividend deposited in your brokerage account, and then you have the option to do multiple things with your dividend. You can take it out depending on which investment account you have, or you can use that dividend to buy other stocks that pay dividends or even growth stocks. The amount of dividends you receive is directly in line with how many dividend paying stocks you own. So for example, let's look at Coke. Coke pays 41 cents per share per quarter in dividend income. So if you own one share in the Coke stock, you get 41 cents per quarter. Times 4 for the year is 164 if you own one share. Now, if you had 10 shares, you would of course not get 164. You would get $16.40 per year for those 10 shares. Now, here's the cool thing about a company like Coca-Cola. And Coke is not the only dividend paying company who does this. Coke has been able to increase its dividend payment by about 7% in the last 10 years. So the first year, if you own those 10 shares, yes, you'll get $16.40. But the second year, your dividend income has potentially increased by 7%. Take that dividend income and reinvest it into buying more shares of Coke, or you can take that dividend income and spend it on buying different companies that also pay a dividend, and also put more money into your account to buy dividend paying companies, and you're on your way to slowly growing your wealth. So let me reiterate. The 4 ways to snowball your dividend income and your dividend wealth is to reinvest the dividends that you get from these companies. The companies, if you've done your research, they should be able to grow their dividend income faster than inflation, so at least 4%. Some of these companies also pay a special dividend every now and then. And then you want to put more money into your account to buy dividend paying stocks. Those are the 4 ways to snowball your dividend wealth. So why do some companies actually pay a dividend? Well, a dividend is like an appreciation to the shareholders for actually believing and investing in the company. Whenever a company goes through an IPO, they go to the IPO, initial public offering, because they wanted to generate enough capital in order to expand their business practices. And the investors that believed in the company get their repayment in the form of a dividend. Another reason also is that people that actually work at the company, upper management, even CEOs, they might also own stock within that company. So it's in their benefit that the company does well and is able to increase the dividend because it will directly benefit them and their pockets. And then lastly, of course, having a dividend paying stock brings stability. It brings long-term shareholders to the company. Dividend paying companies, also called blue chip companies, are a lot more stable than growth stocks when you look at the stock market. So whenever you see that there's a stock market dip or a stock market crash, it usually hits the growth stocks first, particularly tech stocks. When you look at the dividend paying companies, yes, they do get hit also, but they're able to recover faster and they don't get hit as much as the growth stocks. Hit meaning shareholders selling their shares. Usually with those dividend paying companies, yes, the price might go down, but some of these companies still pay their dividends, and especially a dividend that increases year over year. So shareholders just keep holding on to the dividend, to this dividend paying stock, because they don't only pay attention to the price of the stock, they particularly pay attention to the dividend that they receive. Think about the products that you use on a daily basis. and see if those companies actually give out dividends to their shareholders. So, for example, if I think about my daily life, of course, I wake up in the morning and I brush my teeth with Colgate. So, Colgate, I jump on the Colgate website, boom, they pay a dividend. Okay, but I still have to do some analysis before I add them to my watch list. But Colgate is actually one of those companies that I do have on my watch list. Clorox is another one that comes to mind. Even Nike. Some of the shoes that I own are Nike shoes. Nike is also a company that I have on my watch list. So that's one good technique to use also. Look at the products that you're using on a daily basis and see if those companies give out dividends to their shareholders. Nothing is better than using products, and while you're using it, you also know that you're getting paid a dividend from those specific companies. Another technique you can also use is look at buying stocks on the list of dividend achievers, dividend aristocrats, dividend champions, or dogs of the Dow. Now keep in mind that if you're not the type of investor who wants to go out there and pick and choose individual stocks that pay a dividend, you can always look at mutual funds, index funds, or ETFs that are dividend focused from companies such as Schwab, Vanguard, or even Fidelity. Dividend investing has definitely changed the way I look at investing. It pretty much has changed my investing style. I used to be a passive investor, so I would invest in index funds. I've never invested in a mutual fund. But once I taught myself how to analyze companies using fundamental analysis, and then when I learned about dividend investing, it changed my investing style. Nowadays, I also use some technical analysis, some day trading techniques, like right before I'm ready to buy a specific stock. But yes, definitely dividend investing has changed the way I look at building wealth. With my dividend strategy, I focus on creating a passive income stream that will build me wealth that will eventually lead to financial freedom. Now, the big dogs like Warren Buffett and Bill Gates, they build their wealth in their holding company. So, Bill Gates has Cascade Investments and Warren Buffett has Berkshire Hathaway. But everyday regular investors like you and myself, we can build up our wealth in our regular investment accounts. So let's take a step back. Let's look at what a dividend paying stock actually is. When you take a step back, the bigger picture is that whenever you buy a dividend paying stock, you're buying an asset that has the potential to go up in value. But while you're holding on to it, it constantly pays you an income on a frequent basis, usually quarterly. The goal then is to keep buying these assets that keep paying you an income in the form of a dividend until you are able to live off that income, of those dividends. The last step is that you're going to be able, once you've built up this wealth, you're going to be able to pass it down to your family or next of kin, creating generational wealth. So in order to build all this wealth, which you are then able to pass down, you do need to look at analyzing companies that are trading on the stock market. Now, not all dividend paying companies are worth investing in. That's why one of the criteria that I've always had is that any dividend paying company that I look at needs to have been paying a increasing dividend for at least 10 years. Even better is looking at what this company paid as a dividend during a financial crisis, so a stock market crash. Usually when the stock market crashes, some of these companies, they might cut their dividend or they might even cancel their dividend. I don't like investing in those types of companies and those types of dividend paying companies. There are dividend paying companies that even during a financial crisis, they still pay an increasing dividend. Two of those companies that come to mind are Pepsi and Coca-Cola. Coca-Cola has paid an increasing dividend since 1963, around 1963. And Pepsi has paid theirs since 1973. So think about that large of a time frame and what has happened in the stock market, all the ups and downs, all the crashes. Even during the dot-com crash and during the housing market crash, Pepsi and Coke still were able to pay an increasing dividend. Now, Coke and Pepsi, of course, are not the only two high-quality dividend-paying companies. We will look at a long list of other high-quality dividend-paying companies that qualify for my criteria. But let's bring it back and let's look at actionable steps for your dividend strategy. What you want to do is find high quality dividend paying companies. Second, put them on your watch list. Third, buy them when they're selling at a discount. And fourth, manage your portfolio, your dividend income portfolio. So of course, whenever you buy them, they go in your portfolio, but you still need to manage them because not because a dividend paying company is a high quality today, does it mean that it will be one in the future. For example, this year I had to sell my shares in Disney because Disney decided to cancel their dividend. Because of the global pandemic situation that we're in, Disney had to close their parks, which ended up hurting their bottom line, and they had to decide to cancel the dividend. With the asset not paying a dividend anymore, the asset being the Disney stock, I'm not gonna hold on to it. Now, where do you actually find these dividend paying companies to add to your watch list and to your portfolio? There's three ways that I do it. Either by looking at products that you use on a daily basis and seeing if those companies give a dividend to their shareholders. Number two is to look at stock screeners. And number three is the holy grail of dividend paying companies, a list of dividend paying companies, which is David Fish's Dividend Champions Excel spreadsheet. Of course, there's other techniques that you can use like the dogs of the Dow, looking at the dividend champions list or even the dividend aristocrats list. The next step is to buy these dividend paying companies when they're trading at a discount. You never want to pay for an overpriced stock. Now, how can you decide if a stock is actually overpriced or trading at a discount? Let me give you an example and then I'll tie it in to a financial or a stock market metric that we use to decide if a stock is overpriced or not. There's a group of entrepreneurial teens and they've set up their own lemonade business. Their lemonade business is so profitable that they are generating $100,000 in profit each year. So if you take their sales and you take out their expenses, what ends up is their net income or their earnings, which is their profit of $100,000. Now, they've been able to generate $100,000 per year for a couple of years, and they got tired of this business and they want to move on to something else. They are really entrepreneurial, so they want to try their hands in different businesses. They decide to sell this business to you. If money was not an issue, how much would you pay for this business? So keep in mind, this business constantly generates $100K in profit every year. If money was not an issue, how much would you pay for this business? So one way, and also my favorite way to decide how much you should pay for this business, is to think about how fast you can get your invested money back. So if this business makes $100K, let's say you are able to negotiate and buy this business for $100K, you would get your initial investment back within a year, and everything after year one would be a pure profit. Now, if you paid $200,000 for this business, it would take 2 years for you to get your initial investment back, and then everything after year 2 is total profit. The benefit of this is that once you get your initial investment back, you own the business and you can take your initial investment and invest it in a different company. So let's say these entrepreneurs come up to me and they want to sell their lemonade business for $100 million. Keep in mind it only generates $100,000, but they want $100 million for their business. I'm not gonna buy it because it's gonna take me 1,000 years to get my investment back. People don't even live that long. So there needs to be a balance. After some negotiations with the entrepreneurs, they decide to sell their business to me for $1 million. That means that I will get my investment back in 10 years. So to say it another way, I paid 10 times the profit, the earnings, or the net income of the company. The company is generating $100K and I paid that times 10, 1 million. On the stock market, there's a specific metric that we use, which is called the PE ratio, the price to earnings ratio, or price divided by earnings. If you think about the company, the lemonade company that I bought, the price was 1 million and the earnings was 100K. But if you look at a stock such as Coca-Cola, Their price is $51 and their earnings, which is net income per share, was $2.12. Take the price, which is $51 divided by 2.12 is 24. So you're willing to pay 24 times the earnings of the company. Now, when it comes to buying these dividend paying companies at a discount, I'm looking for a PE ratio of 20 or less, and 15 or less is even better. The last step is to grow your dividend income portfolio by constantly buying these high quality dividend paying companies that you have on your watch list at a discount, and then you only sell companies that either cut their dividends or cancel their dividends. So how I pick my stocks is highly influenced by Warren Buffett himself, and of course his teacher Benjamin Graham. So one of the things that I learned from him was, whenever you're buying a stock, you should always think about the underlying company that you're buying. And I'm paraphrasing, but he said something similar to, if you had the money and you are not willing to buy the whole company, why even buy one share in the company? So I look at buying companies as each company has their own report card. So if you're in school and you have your report card, you might have different subjects such as math, history, English. But when I think of a company, they have their own report card, they have their own subjects and their own financial metrics, which I score them A, B, C, etc. But before we talk about those financial metrics, let's look at the very first thing I do before I decide to invest in a company. And that is, I need to know what this company actually does. What's its business model? I always look at it from a standpoint like, I need to be able to explain to a 10-year-old how this business makes money. For example, Chipotle, which also stands for Chipotle Mexican Grill, is a restaurant chain that sells specific items, food products to their customers, such as burrito bowls, burritos, taco salads, and tacos. The Pepsi Company. So Pepsi is an international food and beverage company which sells its products to customers globally. Some of the brands that they own are Frito-Lay, Quaker, Gatorade. Now, of course, this is not an endorsement for Chipotle or Pepsi, even though I have Pepsi on my watch list, but that just goes to show that whenever you're investing in a company, you do need to know what that company actually does. How does that company make money? Now, you can find all this information on the company's annual report, their 10K. Some companies are a lot harder to explain and to figure out what they do, but the 10K tells you everything you need to know about how that company actually operates. Now, the next thing that I pay attention to when I want to invest in a company is to make sure that that company has a competitive advantage. Warren Buffett also calls this a moat. Now, a competitive advantage is a product or service that's unique, that can only be created by one company, a specific company. And the customers only expect that product from that specific company. So for example, let's say you want to buy a Big Mac. You can only get a Big Mac from, you guessed it, McDonald's. You cannot go to Burger King to get a Big Mac. Or think about the Ferrari car. You can only get a Ferrari car from one car manufacturer. This competitive advantage gives these companies cash cows when it comes to products or services. They can increase the price on these products and not lose customers, because the customer can only go to that specific company to get that product. The opposite of a competitive advantage is a company that sells a product or service that's price sensitive, meaning that the cheapest price will get the customer. Think about it like this. Let's say you go to your local grocery store and you want to buy sugar. It's more than likely that you're going to buy either the cheapest sugar or the sugar that's on sale. Or let's say you're browsing online and doing some comparison shopping because you want to buy a flight ticket to Florida. It's also more than likely that you're going to buy the most affordable one. Now keep in mind that if a company has a competitive advantage, and of course the company's brand can be its competitive advantage in itself. Think about Apple or even Disney. These companies can keep increasing the price of their products or services while still retaining their customer base. Now, on this end, if a company is selling a price-sensitive product, they are always going to be in competition with their competitors, and the only way that they can get customers is by offering the best price or the cheapest price. this can potentially hurt the company's revenue, which they're gonna have a hard time growing revenue year over year. Now that's the first metric, the first financial metric that I look at when analyzing a company. So I like to look at the revenue and see that a company is able to grow its revenue year after year. Now, of course, a company has multiple ways of doing this. Some of those are selling more products and services, even expanding into different territories, or one other one is cutting costs. But here's the cool thing about a company that has a competitive advantage. A company with a competitive advantage can sell the same amount of products year after year to the same customer base and still grow revenue. Now, how is that possible? For example, there is a chewing gum company that sells chewing gum for $1, and they have a customer base of 100,000 customers. So year one, they sell 100,000 chewing gum to those customers and they make 100K in revenue. Now here's the cool thing. Year two, they decide to increase their price from $1 to $1.25. They still have their 100,000 customer base, but what happens to their revenue? Their revenue went from 100,000 to 125,000. So they sold the same amount, they still have the same customer base, but just by increasing their price and retaining those customers, they've been able to increase their revenue. The next metric that I look at, the next financial metric, is actually a very important one. Now, whenever you think about investing in a company, why do you invest in a particular company? Is it because this company treats its employees the correct way? Is it because this company is socially responsible? Now, both of these things are good things to have in a company, of course. But when it comes to investing, from an investment standpoint, a great company is a company that can always increase its net income. So what I look for is a company that can increase its net income year over year. But the cool thing is that if this company can increase its revenue, it should be able to also increase its net income year over year. Now the next one is a pretty interesting one. If you take the net income divided by the revenue, you get the profit margin of a company. I use the profit margin to see how well management is performing within that company. When I look at the profit margin, I'm also looking for consistency. And if profit margin is growing, even better. In a situation where you have good or great management, they're able to grow revenue and they're also able to grow net income, which will make the profit margin look great, of course. Now, in a situation where you have bad management, or even in a situation where the company as a business model does not really working out for the current business climate, this company and management associated with this company, they might not be able to grow revenue. Revenue might be flat or even declining, but they still want to grow their net income. So what ends up happening is that management might start to cut costs. So they might fire people and the existing employees have to do more work, but there are less employees available to do all this work. So the profit margin tells me a lot about the company. When I look at the profit margin and it stays consistent, that's something that I always look for, consistency. But when I do see the profit margin declining, that's when I do a little bit more research when it comes to the company that I want to invest in. The next financial metric that I look at, and this is more of an optional one, is to see if a company is buying back its own shares. And this actually ends up benefiting me if I already own shares in this company. Because while I'm owning shares in this company and the company is buying back its own shares, my ownership in this company keeps growing. So for example, easy example, let's say a company has 10 shares on the market and I own one of those shares. So I own 1/10 of the company or 10% of the company. The company decides to buy back 5 of the 10 shares and now there's only 5 left. So the company bought 5, retired those 5 shares, so now there's only 5 shares on the market. I still own my share. So now instead of owning 10% of the company, I actually own 20% of the company and I didn't even have to do anything to grow my ownership within the company. One trick that a lot of businesses use is to buy back more shares during an economic downturn. Because in an economic downturn like a stock market crash, stocks are usually selling real cheap. So whenever a company wants to buy back its own shares, it can buy them back at a steep discount during a stock market crash. The next metric that I look at is the debt to equity ratio, which shows me how much debt a company actually has in relation to its shareholder equity. Now, there are no hard and fast rules, but I like to see a consistent debt to equity ratio of less than 1. Some industry have a higher debt to equity, but less than 1 is usually what I'm shooting for. And of course, the debt to equity ratio is calculated by taking the total liabilities and dividing that by the shareholders' equity. Another calculation that I like to do when I'm looking at debt is to take the total liabilities divided by the net income before taxes. This shows me how fast a company can pay off its total debt using the net income it generates. What I'm looking for is 7 years or less, or even like 5 years or less. The less years, the better, of course. The next one that I take a peek at is the return on equity. So this is a pretty easy calculation. Just take the net income divided by the shareholders' equity, which pretty much tells you how much net income is being generated based on the shareholders' equity. Now, great companies with a competitive advantage can generate a high return on equity. For example, there are two companies that you want to invest in, Company A and Company B. You only have $20,000 to invest, so you split it in half and you invest $10,000 in Company A and $10,000 in Company B. So in essence, your shareholder equity in each company is $10,000. Year 1, Company A generates $1,000 in net income, and Company B generates $3,000 in net income. So your return on equity in Company A is 10% and 30% in Company B. If going forward into year 2, the return on equity stays the same, which company would you invest in? Company B, of course, because it generates a higher return on equity at 30% compared to 10%. With return on equity, I also like to look at consistency. With a lot of these metrics, I look at consistency and growth. So even with return on equity, I like to see my return on equity in the double digits, and it needs to be consistent. Besides return on equity, I also like to look at the return on invested capital. Your return on invested capital, also called the ROIC, is your net income minus your dividends divided by your total capital. I like to see this in the double digits also, like the return on equity, ROE, and I'm also looking for consistency year after year. So those are the metrics that I look at when evaluating a growth stock. But when it comes to a dividend paying stock, there's some additional financial metrics that I look at. One of those metrics is the dividend per share. So how much dividend actually gets paid out to a shareholder out of the company's net income, which is also the company's earnings. What I like to see is that a company has been able to grow its dividend year after year. So I like to look at the last 10 years and see that a company has been able to grow its dividends faster than inflation. Because if I'm investing in a company, I want my money to retain its buying power, which means it needs to grow faster than inflation. So what's a good dividend growth rate? Anything higher than inflation. So if inflation is 3 to 4% per year, my dividend growth rate that I like to see needs to be at least 4%. Anything above 4, even better. The next dividend metric that I look at is the payout ratio. The payout ratio tells me how much of its net income a company pays out to its shareholders as a dividend. So for example, if a company generated $1 million in net income and they paid out $500,000 in dividends to its shareholders, then the payout ratio is 50%. Now, when I'm looking at the payout ratio, like with any of the other metrics, I'm looking for consistency. So I'm looking for payout ratios that are either below 50 or 60. Every industry is going to be different. There are some industries where the payout ratio is extremely high, like the real estate investment trust. Those payout ratios can be in the 90s or even more. But what I'm usually looking for when it comes to a payout ratio is anything below 70, anything below 60, and I'm looking for consistency. The last financial metric that I like to look at when it comes to dividends is the dividend yield. The dividend yield tells me how much dividend I'm going to get for the price of the stock. To calculate it, all you have to do is take the yearly dividend divided by the price of the stock. Now, you will come across something interesting when you look at a dividend yield. There are companies that have a high dividend but low growth rate, and vice versa, a low dividend yield but a high growth rate. So which one would you actually want to invest in as an investor? Where there are no hard and fast rules, so you can experiment with both. However, an extremely high dividend yield might need some further investigation. For example, let's say a stock is trading at $100 and the dividend is $1. So the dividend yield is 1%. Now, the dividend stays the same, but the price of the stock fluctuates and the price drops all the way down to $10. Now, the dividend is still $1, but look at the dividend yield. The dividend yield now is 10%. So that looks great as an investor, but that requires some further investigation to see, okay, why did the price of the stock go from $100 and dip down all the way to $10? You might be thinking, this is all fine and dandy. I like these financial metrics, but where can I actually find these financial metrics? Well, if you look at a company's annual report, you'll be able to get to the company's income statement, balance sheet, and cash flow statement. This is what I use in order to analyze a company and look at the financial metrics. And the last thing that I look at if I want to invest in a company is the company's PE ratio, the price to earnings ratio. As a dividend investor, I like to look at a PE ratio of 20 or less, or I like to see 15 or less. That's even better. Now, when I look at a growth stock, I kind of throw the PE ratio out the window because the PE ratios of growth stocks tend to be extremely high. So I might see a PE ratio of 20 when I'm looking at a dividend paying stock, but when I look at a growth stock like Tesla, it might be 200 or more. So we looked at all the different financial metrics that I use, highly influenced by Warren Buffett, of course, if I want to evaluate growth stocks and dividend paying stocks. The very last step for me is to use some day trading techniques in order to buy that share or buy those shares at the right time. My dividend investing portfolio allows me to sleep well at night. So I wake up in the morning, I log into my brokerage account, and boom, it's been another successful week of investing. Now, this is what happens to other investors. They log into their brokerage account in the morning and they've lost money in their investment. So my dividend investing portfolio is built based on stability, looking at the 11 sectors in the stock market. Now, when you look at the 11 sectors in the stock market, each has its own risk level. So you want to create a portfolio based on weight by sector, which I will link. This is what my weight looks like by sector. Let's say I had $10,000 to invest. 20% or $2,000 would go to companies that are in the consumer staples category. 18% or $1,800 would go to companies that are in the category of consumer discretionary. And the list goes on and on. Now, the reason why I have it set up like this has everything to do with how volatile the companies are that I'm investing in and how safe their dividend is, even in a stock market crash. The companies that I invest in the consumer staples sector, they pay an increasing dividend even in a stock market downturn. Now, if you look at my list and you go further down, you'll see that information technology is not that high up on my list. That's because most information technology companies don't pay a dividend. Of course, there are exceptions like Microsoft and Apple, but most information technology companies, they're focused on growth. And these are also companies that are extremely volatile. So they go up fast when you look at their stock price on the stock market, but in an economic downturn or a crash, they also dip down the fastest. Now, I mentioned that there are 11 sectors in the stock market, but when you look at my list, you'll see that I have financials and real estate combined. That's because when I created my list, there was no real estate sector. Now, let's take a look at the weight by sector when it comes to the S&P 500. If you take a look at this weight by sector, you can see that information technology makes up almost 26% of the S&P 500's weight. So let's say you're investing in an index fund. This is what your allocation will look like when it comes to the weight by sector. Now, this is way too aggressive for me, the number one, 26%, because I have information technology at 6%. Now, am I telling you not to invest in the S&P 500 index fund? Of course not. I'm investing in an index fund that tracks the S&P 500. The one that I'm investing is the one from Vanguard. What I am saying is that you need to pay attention to what you're investing in, even when it comes to weight by sector. Because if you look at this list, the information technology sector gets hit the hardest when it comes to an economic dip or an economic downturn. Another good tip for your dividend investing portfolio is to look at companies that are outside of your own country. So I'm in the US, so I usually invest in companies within the US because from a dividend standpoint, I've noticed that the best paying dividend paying companies and the companies that are the most consistent with increasing their dividend are in the US. But that doesn't mean that there aren't other countries that also have great dividend paying companies. Some of the other different countries that you can take a look at when it comes to dividend paying companies are, of course, Brazil, South Africa, China. Just do some research online, use a stock screener, and you'll be able to find some good ones out there. One great company that just popped up in my mind is Unilever. Now, this company is headquartered in the UK, but the biggest brand that I know that they own is Ben & Jerry's. Unilever also pays a healthy dividend, which they've been able to grow year after year consistently. Now, one thing that I do have to mention when it comes to your dividend investing portfolio is that you don't want to be so rigid in your investing style that you don't have fun when it comes to investing. Too many rules will take the fun out of investing. So what I'm pretty much saying is that if there is an investment out there that you think will do good, go ahead and try it out. Like for example, I tried investing in Bitcoin and Litecoin a couple of years ago. Now, that is outside of my investing style, but I still want to have fun when it comes to investing. You never want to be so rigid that you will only stick to one investing style. That being said, you do want to look at your risk. So when I invested in Bitcoin and Litecoin, I just invested a small amount. I didn't take a large sum of money and invest it in Bitcoin and Litecoin, which is something that I'm not too familiar with. So yes, when it comes to investing, have your investing style, have your dividend investing portfolio, but also leave some room open to have some fun and invest in different types of securities that you think will do well in the future. Now let's go ahead and delve in a little bit deeper into those 11 sectors in the US stock market. Number 1, consumer staples. This sector consists of products consumers use on an everyday basis. Even in an economic downturn, people will keep using these as they are always in demand. They consist of beverages, food products, household products, personal products, and tobacco products. So some examples of these companies are going to be Procter & Gamble, Kimberly-Clark, Estee Lauder, Pepsi, and Coca-Cola. So the reason why I have consumer staples at 20% when it comes to my dividend portfolio is because the companies in this category, like I mentioned, they have a competitive advantage. So even in an economic downturn, they perform well and they still pay the dividend, because with a dividend portfolio, my focus is always on the dividend. The dividends needs to be stable and the dividend needs to grow every single year. Number 2, consumer discretionary. These are the non-essential products or services that consumers could live without. If the economy is doing badly, people cut back on consumer discretionary products. They consist of media, auto components, hotels, cruises, restaurants, vacation resorts, apparel, and cars. Some examples of these types of companies are Disney, Yum Brands, McDonald's, Fastenal, and Walmart. So consumer discretionary is my number 2 when it comes to my dividend portfolio, weight by sector. Now, even though I have them at number 2, consumer discretionary companies, they perform on average worse than consumer staple companies when it comes to an economic downturn. The thing, however, is that many companies in this sector still have a competitive advantage. So even in a stock market downturn, they're able to bounce back faster than, for example, information technology companies because of their competitive advantage. Number 3, energy. Energy companies consist of the production or supply of energy worldwide. For example, Kinder Morgan. The next one, healthcare. There are a variety of companies in the healthcare sector, such as drug manufacturers, biotechnology, healthcare providers and services, medical appliances and equipment, and medical research. People always require medical attention and medical aid, so this is a sector to always keep an eye on. Some of the companies in this sector are going to be Johnson & Johnson, Abbott Laboratories, and even AbbVie. Now, when I look at healthcare and I look at my weight by sector, I would like to push healthcare above financials and real estate. The only reason why I haven't done it though is because there aren't that many healthcare companies that hit all my qualifications. There are some like Abbott Laboratories and AbbVie and Pfizer, but I would need more in order to increase my weight by sector when it comes to healthcare. Financials. When you hear financials, you immediately think about banks, but this sector also consists of insurance, asset management, investment brokerages, and credit services. So some examples of these companies are going to be Chubb, T. Rowe Price, and even Visa. And also real estate, which I have combined with financials. When you think about real estate, you always want to look at REITs, which is Real Estate Investment Trust. Some of these companies are going to be Realty Income, which is a monthly dividend paying company, and Omega Healthcare. Utilities. Companies in this sector mostly carry a large amount of debt. These are electric utilities, gas utilities, water utilities, and multi-utilities. These are often considered boring companies to invest in. Some examples are Avista Corporation, New Jersey Resources, and South Jersey Resources. When it comes to utility companies, I have them lower on my different strategy because they have a lot of debt and they have a high payout ratio. Two combinations for disaster. So if there's an economic downturn or economic trouble, they might not be able to keep paying a dividend. Telecommunication services, also now called communications. Communication services companies have set up an elaborate infrastructure that gives us the ability to communicate with our family and friends all over the world. The biggest section is wireless communication. Two examples of companies in this sector are going to be AT&T and Verizon. I tend to stay away from companies that are in the material sector because these companies provide goods that are, first of all, highly cyclical and then also highly price sensitive, meaning that the lowest price will always get the customer because they don't have a competitive advantage, so they can only compete based on their price. Now, some examples of companies in this sector are Air Products and Chemicals, Chevron, and ExxonMobil. Industrial goods. This sector, also highly dependent on demand, consists of different companies in different categories, such as aerospace and defense, airlines, machinery, construction, railroads, electrical equipment, commercial supplies and services, building products, and industrial conglomerates. Some examples are GE, Emerson Electric, and Dover. And the last one, information technology. So many companies in this specific sector are favorite companies of many investors because they're mostly growth stocks, of course. People also like being associated with the coolest tech companies that are creative and always push the limits of what is possible. Competition is extremely high in information technology, and it's not unusual to see today's cool companies be tomorrow's forgotten relics. Many tech companies also don't pay a dividend because they'd rather use the money to grow the company instead. The information technology sector consists of software, hardware, IT services, communication equipment, internet services, and semiconductors. Some examples are IBM, Qualcomm, Texas Instruments, and Cisco. As a value investor, I try to stay away from the information technology sector because, of course, most of the companies don't pay a dividend. And then also it's hard to keep up with these companies because they're here today and then a year or two from now, they're gone. Those are not the types of companies that I like to invest in. If there are information technology companies that I invest in, those are going to be your Apple and your Microsofts. Just keep in mind that I don't have a favorite company that I invest in when I look at my dividend portfolio. Because if a company that I invested in, if they stop paying a dividend or they cut their dividend, I'm selling that company. So if you like this topic about investing or even dividend investing, make sure to check out my other videos.